Well, holy smokes, the Qs just broke their downtrend on the day. The downtrend was pretty nasty. We were watching it this morning in the course member live stream and the stock market open live stream, the free one over at the Meet Kevin live channel. And boy, oh boy, things are rallying. Why? Well, the only thing that came in right around this time was at 8 o'clock right there. Right there, the bottom basically, all we got were the New York one-year inflation expectations, which actually came in slightly higher than the previous, or than the current survey. Survey was 3.01, it came in at 3.02, which is a little higher. Why then are the Qs skyrocketing right now? Well, it's because the inflation expectations are down from the 3.17% in the prior, and we got to start considering some of the other seeds that are being planted right now. First of all, Nick T over at the Wall Street Journal, he had a fantastic post on some things to pay attention to regarding the Fed and where we're going potentially with Fed rate cuts. Right now, we're looking at the smallest gain in average hourly earnings since 2021. Nothing alarming enough to force rate cuts in July, but eventually further weakening in the labor market won't be desirable. And if we get a soft CPI and PPI report this week, Thursday, Friday, we might end up being in talks for September cut. So Nick T is starting to do the Nicky leaks part of his job, which is starting to leak kind of what the Federal Reserve wants markets to think. And basically, the Federal Reserve is starting to prime us to say, look, if we get a weak inflation read on Thursday and Friday, we're going to start cutting, and the market's probably going to pump it up on that news until we actually start having to price in a recession, which at this point isn't too exciting, or nobody wants to talk about that right now. That doesn't mean the market isn't due for a correction, but the point is it's really hard to bet against a rally while the rally is going. You kind of have to keep betting with the rally. The trend is your friend. And then when it U-turns, be quick to adapt. This is what we're doing in the Stocks and Psych group. For example, the alerts that I sent out today, I threw money into Tesla calls. Those are up 45K at the time of this reading here. Enphase call up 23K. And that was like a 60K investment, so that's up 35%. Palantir calls are up 23%, $21,000. I've got 2 AMD calls. One of them's down, one of them's up. Yeah, so AMD's getting a little stuck in the mud. But all of these, by the way, I think have some real momentum ahead of them if we can get positivity about rate cuts and inflation continuing this week, which I think that's why right at 8 a.m. this morning, when those New York Fed inflation numbers came in roughly as expected, the market was like, license to rally, baby, let's go. Because the market is often fearful about, oh no, what if we get a bad report? Jay Powell speaks tomorrow morning, but Jay Powell's probably just going to reference, the importance of the CPI and PPI numbers coming up. So Jay Powell talking in the House tomorrow, will cover it to see if there's anything special. I'm not expecting anything other than what we saw from Sarah Eisen last week. Then, of course, we have Jay Powell speaking in the Senate the next day, which will basically just be a mirror image of what we had or have tomorrow. So I'm not too worried about that. Instead, I'm going to be looking at CPI, which is Thursday morning. We're expecting CPI month over month to come in at just 0.1%. That is a little up from the prior 0.0, and core CPI expected to come in at 0.2. Some, like Morgan Stanley, think that'll come in at 0.27. Year-over-year CPI coming down to 3.1 is the expectation. Core year-over-year 3.4. PPI looking at the month-over-month 0.1. Core month-over-month looking at 0.2 on both the core with trade and without trade. So, and then, of course, you've got University of Michigan sentiment reads, which will come out on Friday. So overall, all of these are things that could really promote an excited market. Personally, and I'll talk specific trades here for a moment, but I do want to give some credence to the potential risks that we're facing in the economy. So we're going to go ahead and pull those up from ehack.com. But some of the things that I'm paying attention to, at least in trading, is I'm specifically watching the uptrend on Palantir. There's substantial uptrend momentum on Palantir. I'm watching the breakout above 165 on AMD. That's a really big deal since AMD is one of the biggest laggards in the AI race. The fact that it's breaking out above 165 and it's only done that so far for one full day on the candlesticks is a good technical indicator. You've got the momentum at Palantir, which is great. The social sentiment's massive. Enphase, you just had an upgrade on S-Edge, which is probably why Enphase is moving up as much as it is today. And honestly, it's probably just going to keep going. I mean, no, I can't guarantee anything, obviously. I don't have a crystal ball. Ultimately, you have to make your own decisions. But what I think is interesting about Enphase is we just had a local bottom at 95, and then you got this industry upgrade. I think you're potentially setting up for a Tesla moment at Enphase. So I'm starting to get really excited again over at Enphase before it actually starts going euphoric here. And Tesla is about to test the 258 level. Once we break 258, okay, personally, I think most of the order book at 250 has already been cleared. In fact, we came back down, we tested 250, we bounced off 250. How much more of an invitation do you want on Tesla, okay? The 250 order book, I think, is the big sell order book. 258 is technically the fib level, but I don't actually think we're going to get a lot of selling pressure here. It would make sense if we have some, because it is a fib level. But guess what happens after 250, folks? 295! And Tesla, in my opinion, doesn't get euphoric until we hit 331. So between now and Robotaxi Day, let's just say I got some calls on some of these, okay? And remember, if you want to see exactly when I'm entering and exiting trades, no guarantees we can make money, but I send all my alerts to those of you in the Stocks and Psych group, link down below. Next price increase is Friday. We actually extended the July 4th through this week just because we have CPI, PPI. There's a lot of people are a little uncertain, so they're kind of waiting to see what happens with data. So far, data seems to be doing well, but there are some risk factors. Look at this. You've got UniCredit that says, look, we've got to seriously start worrying about the cooling in the labor market because we have just late cycle jobs that we're creating. Healthcare and government jobs are late cycle acyclical jobs. In other words, when the economy goes down and starts faltering, these are sectors that might still be adding. And that's dangerous because they give you this false read of how strong the economy truly is. Because if you remove those, you might be closer to, a 50,000 job gain rather than a 200,000 job gain, right? 75% is being contributed by government and education. And that would be a substantially weak labor report, which the Federal Reserve would likely respond to with more rapid cuts. Now, UniCredit thinks we really need to start thinking about rate cuts very, very quickly. Especially since, and I was kind of combining this in here, construction is another sector that's showing growth, but it's really lagging, in my opinion, because housing starts are trending down. But, you still got to complete the prior starts, so it kind of takes time for you to see construction lag down. I personally mentioned that I'm still at a 6.7 on the bull-bear scale, mostly because a lot of people are saying to me, they're like, look, Kevin, UniCredit's begging for rate cuts, even though they're worried about it coming across as political. It seems like the economy keeps going up. Kevin, why aren't you maybe more allocated in your personal portfolio to going all in, going margin? Why aren't you going nuts right now and trying to milk everything? I'm a big fan of trading in this environment. But what I am 100% not willing to do is end up in a recession and then eliminate my personal ability to float all of the startups that we have. So we've got, not only obviously like the YouTube business, which is a very high margin business, it's low expense, so I'm not so worried about that. But, we've got HouseHack and we've got SuitHack, a broker dealer. These are, and both of them sort of contribute to each other. SuitHack probably benefits HouseHack more. But these are very, very, relative to the YouTube business, cost-heavy businesses. And if we go into a recession, I will not be one of those people who ends up having my companies fail just because there's a recession. So it's one of the reasons I'm putting a lid on my enthusiasm and saying, look, I'm willing to be cautiously optimistic, but I'm also not going to be caught with my pants down in a recession. So that's very, very important. So everybody, this is why I always say, while we talk finance on this channel, it's always very, very important that you analyze finances from a personal point of view. The FOMO, the fear of missing out, should not be a reason to put yourself into a substantial risk category that ends up causing you substantial pain if we do go into a sudden recession. Because we have to be real. Yes, the SOM rule is getting closer to indicating a recession coming, but, thing about the SOM rule is the SOM rule basically compares back to the moving average of last year. So it says, hey, once the unemployment rate goes up, a certain percentage above the 12-month moving average of last year, then we go into a recession. And we're getting close to triggering that. Like, let's say the top of this camera frame here is where the trigger is. We're probably right here right now. But the problem is, it's not necessarily a problem, it's a feature. The SOM rule is designed to measure volatility in joblessness. So when a lot of people lose their jobs quickly, the SOM rule triggers. It's like, oh, this has got to be a recession. But what happens is if the unemployment rate, let's say, stays stable at 4.1 for the next 2 months, thanks to immigration, legal, or whatever, doesn't matter, illegal, both get counted, right? Then the 12-month moving average of the unemployment rate will actually move up. And then the difference between the two will narrow, and the SOM rule will actually come back down. So it hasn't fired yet, and it's possible it won't fire at all. And this is the frustrating thing is data is just so messy right now. There are no shortages of, Peter Schiff saying, oh, but, U6 unemployment's over 7%. Yeah, dude, it's been over 7% for like a year. And I love Peter Schiff, don't get me wrong. I'm just saying, like, there are no shortages of being able to find bad data right now. I mean, look at ISMs, okay? ISM services, I put this over here. These red arrows are all recession indicators. Every time ISM services fall under 50, you get a recession. Oh, but wait a minute. What happened in December of 2022? It triggered under 50. Oh my gosh, we're still not in a recession. Now we're under 50 again. Is this time different, or is this time just delayed? I personally lean towards this time as just delayed. I think the market has a lot of euphoria between now and pain. And yeah, don't get me wrong, I do think there could be pain coming towards the beginning of 2025. But for right now, the economy continues to chug along, and the stock market is just going to keep pumping, probably because of that. So that's why I think this is a very difficult market to put down, in other words, buy puts on, and it's a much easier market to just have calls on. So we'll see. Then take a look at this. How worried should we be? Macro surprises turn negative across major economies. So basically, this is a way of saying that economists are sort of getting surprised by bad data, and they're not expecting it, which makes people, it basically is a sign that people think the economy is stronger than it is, which is not great. Let's be clear about that. It's not great. Academy Securities is worried that if we begin to cut in September, it'll seem too political, but, what are you going to do? French elections obviously didn't give us a lot of clarity in what's going to happen in France, but that also is what it is. It's one of those, what are you going to do situations. But, folks, this is my overall take here. How should I summarize this? I think the best way to summarize it is, frankly, I think the market is going to continue to go through a period of euphoria and topping until we actually start getting some black swans. Obviously, when we start getting some really negative data, you're going to want to be quick, and this is going to be hard. Like, you're going to want to be able to transition your portfolio very, very quickly. And I don't know how quickly people are going to be able to transition. And I'm not saying that, you need to run for the covers, run for shelter now and, quick, hide your kids, hide your wife, everything's going to poops. We're not there yet, but it would make sense that we're getting closer to topping out, especially as we're starting to get some GDP data coming in a little softer. I always like to jump on over to the Atlanta Fed, real GDP measures. And when you look at these, they're definitely falling. Real GDP is coming down. Right now, it's being estimated at just 1.5%, which you think would lead the Federal Reserve to want to cut. But not really, because if you go to the FOMC's last summary of economic projections, their dot plot, they tell you that they actually expect GDP for this year. Right, where is it? There it is. GDP for this year to sit at 2.1, and that's roughly what we've been averaging. The question is 1.4 going to be something that's going to trigger them to cut? And that, I think, will take much more than just 1 month of weakness in the Atlanta Fed GDP reads. Hence, for me, I think we're probably lining up for a September cut, which, yes, will appear political, versus a July cut. I can tell you, though, what the market is pricing in. Let's go ahead and take a look at market pricing because we generally like looking at that. Market pricing right now is looking at a September 81% chance of a cut, pricing in 1.25 cuts for November, and pricing in a full 2 cuts for November, with 2.5 cuts priced in for the end of January. So anyway, make sure to check out the programs on Building Your Wealth. Link down below, meetkevin.com. Email us at staff@meetkevin.com if you have a bundle coupon inquiries. Thank you so much for continuing to watch. Subscribe. Really appreciate it. And we'll see you in the next one. Goodbye. Good luck.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than HouseHack, nor am I presently acting as a market maker. Make sure if you're considering investing in HouseHack to always read the PPM at househack.com.